Okay, guys. Good morning. So I'm Trader Benny, and I'm going to continue from where I stopped in the last presentation. Okay, so I think I have some questions here. Mm, okay. Uh so I would just come back to these questions. I mean, because uh so I'll go through the questions and then I will respond to the question in there. Okay. The assignment, this has to be where we stopped. So I want to believe all of this imbalance. That is very correct. That is very correct. Yeah, from this week to the other week. That's correct. That's correct. That's correct. What do we have here? POI. So I have not taught you how to mark a POI yet. I haven't taught you how to mark a POI yet. So I'm not sure if these ones are correct. Because I mean it's zoomed in. I cannot see the bars. Okay, because I need to see the week, I need to see the bar, I need to see it's not clear enough for me to see. But I think the break of structures, they look good. What's this inducement? That's not inducement. That's not inducement. Inducement is not in the internal structure. Inducement is on the actual swing structure. That's where you find inducement, not within the substructure. Not within the substructure. It's within the swing structure or the minor structure, which will now eventually become the next major structure. So if you call this one inducement, you are correct. But if you call this one inducement, it is not correct. It's not correct. Right? Because I mean, the inducement here is not useful. Right? It's not like it's not useful. It's just it's another type of liquidity, right? It's not an inducement. Inducement means to deceive, right? It means to deceive somebody. It means deception. It means to lure someone, right? To induce you to do something. Okay, so if you interpret what you're doing here, that because this is a pullback, in the technical, technical side of things, right? It doesn't induce anything, right? At least with the way we read market structure. Why? Because there's no break here. If this pullback had led to a new high, then traders would say, oh, supply is failing, there's a break of structure, right? Supply is failing, there's a break of structure. So it induces them to try to buy from here, right? So that's why we say inducement is the pullback. You see it now, traders see that, oh, this one pullback, it broke structure. Okay, fine, it's an inducement for them to try to buy. That's what makes it an inducement. Okay, not that it pulled back and came, and then it means you're going to mark inducement everywhere on your chart. Okay, because I always say that there has to be a reason for what you're doing. All right, maybe some other school of thought might agree that inducement can be done this way. It's just really unfortunate that we are equally calling it inducement, right? But that's not what I have taught you to be inducement. And I believe the things I teach you are very clear, right? If you go through what I teach you, it's not difficult for you to understand that this is not an inducement, right? You will know if you have gone through what I teach you. You know that this is not an inducement. You know that this is not a break of structure. This is not a break of structure. Who is this person? This is not a break of structure. Ifesco, I know you're an ICT person. I don't know whether you will not participate with what we are doing, and just follow your ICT, right? So that by the time we get to the point where we are talking about psychology and accountability, then you can fully participate, because you're doing all the examples I see you do here are wrong, because you're using a different thing. This POI here, you have marked it as a POI because you can clearly see that the market bounced from that place, right? I don't know if there is any POI in the middle of this leg, right? I don't know, because it doesn't seem to be present there, right? So what you're calling a POI might just be, maybe there's a breaker block, right? It might be a breaker block. So what the POI here is the breaker block. A breaker block is a type of POI, all right? So there might not actually be an actual candle here where you marked. All right, so follow what I'm teaching. Follow what I'm teaching. Don't bring confusion to yourself. Follow what I'm teaching. If you know you have not studied what I taught, you have not gone through the video, don't do the assignment and confuse the other guys, because some people will come and scroll through some of these things, and when they see, they get confused, right? This is not correct at all. The way you mark the market structure is wrong. What you call a break of structure is not a break of structure, because see, if I'm going to mark what you did here, from here, okay, let's assume we're starting from here. If we call this break of structure, pullback break of structure, it means that this is the last one that we have, right? This is the last one. From here to here, this becomes the new higher low, right? All of this is one leg. You can't come inside. You have a break of structure here. You can't start labeling break of structure inside the minor structure. You cannot do that. It's wrong, right? So it's until the market breaks this level, then you now say, okay, this is your break of structure, right? If this is your break of structure, then the moment the pullback is taken, the first pullback that is taken, you now have you now have a high, right? A higher high. So it validates this as your higher low. So from here to here is one leg. Then this is a pullback. All right? This is a pullback. And then from here again, you go again, right? The moment the market breaks this high, you have a new break of structure, right? It's like coming inside this area and you're saying this is break of structure, this is break of structure, this is break of structure. It's wrong, right? That's exactly what you did here. It's wrong, okay? You can see, this is obviously wrong, right? So you are considering the external liquidity when you go for break of structure, not the high of this guy has not been taken, and you're marking break of structures within this place. So maybe that's the way someone else teaches it, but the way I teach mine is very straightforward, and there's a logic behind it, and it's going to lead us to actually taking entries, right? Going to lead us to actually taking trades. Okay, so don't confuse what you're learning from the other places with what we're teaching here, right? So if you want to participate with the assignments and the other things that I'm giving you, then watch the videos. If you watch the videos very well, you won't do this. I'm very sure about that. So watch the videos. If you're not watching the videos, then don't take the assignment. So like I said, I have not taught you guys POI yet. I believe what I taught you was the fair value gap. I just told you, okay, there are different types of POI, right? But I haven't specifically told you this is what a POI is, right? I have not done that. Okay, this is already looking wrong to me, by just looking at it the first time. This is looking wrong. It's looking wrong. So I have, what's it called? I have, oh, mm, this is wrong. So this is the substructure. I'll take from here because that's the only place I can see. Yeah, this is okay. This is okay. So this is substructure. Okay. I'll take it. 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 This is the swing structure. So the swing structure is all of this, right? The minor and the new one, they are the same. Then you have the substructure. That's what he called SS. And then minor structure, correct? Minor structure leads to the major structure. So major structure is not the area from the breakup structure. Is both the minor and the major, they encompass the major structure, which is the new swing. Okay, so this is okay. This is okay. So from the breakup structure, you have a major. Yeah, this is good. This is good. I think this was the area that made me to judge your assignment as being wrong, because the major structure is not this small area. The major structure is both the minor and the area that broke out, right? That's the major structure. So I say that the minor structure is what is happening before there's a breakup structure, right? That's why we say it's minor, because it has not proven that it is going to be a major structure that we can consider in the future. You understand? So I'll stop there so that I can. I'll stop there so that I can take. I can go forward with some of the things I still have to teach you. Hopefully, if we have time, we can review. We can review some of these assignments in the future. Hopefully. But for now, let me go on, because I need to teach you all of the concepts, correctly, so that we can actually start, sharing the setups together, the trade ideas, if you find a valid POI that you think that we should buy or sell, right? You can share it on the group, and then the other guys will jump into it, So that's what I hope that we can do eventually. So the last thing I showed you, just a brief recap. So I think I talked extensively about the fair value gap. The gaps, they are imbalances. I did justice to this thing, because I can still see everything here, We talked about the first bar, the second bar, the third bar, and how the second bar has an imbalance. There's a gap. Okay, between this and that, there's a gap. All right, and traders are hoping that gap can be filled. At least 50% of the gap can be filled. All right, so let's just go forward, right? Let's just go forward so that I can teach you some new things. There's something we call the premium and the discount. Okay, premium and discount. It's the premium and discount is just an idea that I'm not going to even spend any time on this. It's just telling you that the market should, if you have an uptrend and you want to continue buying, don't buy until the market has gone 50% deep, right? If you want to sell, if you're looking to sell, do not sell if the thing is still 49%. Don't sell until it gets into the premium area. See, the reason here, that's the next thing I'm supposed to teach you: supply and demand, right? Supply and demand, and all of these things are different types of they are all different types of POIs. Okay, although this is not a POI, this is just a concept that your POI must be within the premium or discount area, depending on whether you're buying or selling. If you are, this is what we call it. You see, they put something like this, then there's a tool. I have that tool on my trading view. This area, we shade it differently, and then we say that everything in this area is the premium and everything in this area is the discount. So this is 0, this is 50, and this is 100, right? So what we're saying is very simple. If I come here and I want to, let's say this is going up, this one is going up, and I want to buy, right? I will plug in that tool. It's just, you can use a Fibonacci, right? You can use a Fibonacci from here to here. Where I want to buy from is at least the market must pull till it gets to 50% area. So anything from 50, 60, 70, 80, 90, 100, anything from that area can be bought. But it's assumed that if we have an uptrend and the market is trying to get cheap, that's what premium and discount is, right? It's saying, I don't want to buy it at an expensive rate. I want it to be cheap enough for me to buy. And I mean, it makes a lot of sense, because if you're trying to buy a pullback and your target is at the break of structure, let's say you have something like this, right? You have something like this. You want to buy a pullback, right? You want to buy a pullback. See, if I want to buy, if this is my inducement and my entry is here, my other block is here, right? My other block is here. Why we say at least 50% deep, at least 50% deep, is because if this thing is shallow, if it's here, if it's around here, you want to buy from, this is supposed to be your target. This is your TP. This is your TP, right? So if it's, let's say, 20% deep, right? Your TP is here. What's going to be your risk to reward? What's your risk to reward? It will be small. So it's not favorable. That's what we're saying. All right. So the point here is, take the thing down to, where you have at least 50%. Now it's cheaper for you. If you buy from here, let's say you have a 10 pip stop loss, right? 10 pip stop loss. If you buy from here, you can now go all the way back here. Before you get here, your risk to reward will be good. Let's say at least 5, right? 3. Good risk to reward, right? That's what premium and discount is about. Whether you're talking about selling or you're talking about buying, right? That's what it's about. That you shouldn't buy shallow. Don't buy shallow. Buy when is in premium. And the reason why we call it premium and discount is because of the word supply and demand. For supply, you want to buy in the premium zone, right? In the premium zone. And I'm not going to teach you economics now. I'm going to just teach you what you need to apply these things to your chart, right? For the demand, you are looking for discount, right? So if the thing you want to buy is has a demand, right, at a certain price, for that demand to make sense, you need discount. If there is no discount, there will be no demand. So a good demand is supposed to be in an area of discount. That's the idea. So see, if I have an uptrend like this, I'm going to teach order flow now. This is the demand. This is demand. This area is the demand. This is the area where this is the price where the market gained a strength from, right? So we say this is the demand. So what we are saying is, if you want to buy, you must buy at a discount area. That's where you find the demand. Just understand it like that, right? I'm trying to make it as simple as possible so that it doesn't get complex. So that's exactly what we're saying. So, but if you are selling, see, demand is the uptrend scenario. But if you are selling, what you are dealing with is supply, right? This area is the supply. This is supply. Okay, so supply has to be, if the market is coming up, it has to be at a premium price for supply to be favored, right? You don't want to supply something until the price is at a premium, is high. When the price is high, then you supply. When the price is low, then you buy, right? So I'll just leave it at that. Okay, so I believe you understand the concept of premium and discount, right? And then you know which is for which. So, but the important thing I need you to understand in all of this is that make sure that the POI you are marking, ensure that your POI is within the premium or discount range, is one of the criteria of a valid POI. One of the criteria of a valid POI is that the POI is below 50% on the pullback. Take note of that. All right, that being said, there are other things, we have to look at. I have to quickly go into demand and supply. Before I do that, I'll just quickly touch on volume imbalance, because tell you what, this is part of, it's just very similar to the fair value gap. So I don't want you to see it and then be like, oh, what is this? I think I already touched on this, but I'll just do it. This is volume imbalance. Volume imbalance is when you see an actual gap like this on the chart, an actual gap. See, there's a gap here. That's volume imbalance. Okay, so you can see that the where this candle closed and where this one opened, they are not the same. All right, that's volume imbalance. All right, even if it's just the wick, as long as there's no body close there, even if what you have is just the wick like this, if it's just the wick, see the body, see where the body is, right? You see where the body is. This is where the body is. This is where the other body is. There's no body here. There's no body around this area. Watch. There's no body close. And a normal candle is supposed to be like this. You see it? A normal candle is supposed to be like this. Is it not? As this one closes, the next one will open and continue to run. Right? So, but this one, see, there's a gap. From here, it did not close. It gapped to this place. Right? It came back up, but there's a gap. So this is called a volume imbalance. Volume imbalance. Take note of that. All right. So supply and demand, guys. See, the idea with supply and demand, I cannot teach supply and demand unless I take you back, to Wyckoff, right? I'm not sure if I spelled that thing correctly. Okay, so Wyckoff theory is, it tells you it tells you something about the market cycle. And just before I talk about Wyckoff theory, I will just touch on market cycle, okay? Because market moves in cycles. All right, a market will move from a trading range, right? From a trading range to a breakout. Take note of this, right? From a trading range to a breakout, right? And then to a trend, and then back to a trading range. Now, see, I just said something, and that's what I want you to understand. First, we had a range. After the range, we had a breakout, right? We had a breakout of the range. First, we had a range. Then we had a breakout. Then we had, after the breakout, we had what? A trend. All right, now, the market The market will not continue to trend forever. So, but the market cannot just move from a trend, maybe an uptrend to a downtrend. It has to first dissolve into a trading range, right? It will first go into a trading range. This is the area where, if you understand price action, right? If the market is going up and you draw a trend line, you say, oh, this is a trend, right? There's a point when the market will break the trend line. It will go like this and then go like this, right? If you look back, you see that what you have here is a range. So market will go from trend to range. And then the range, what will happen to the range? The market can stay here for some time, but eventually what? It will break out, right? And then what you have is what? A breakout. So this is the market cycle, guys. Now, the direction is what we are not sure of. The direction is are we going after the range? Of course, from the point where you have range, you do not know where the breakout will be, whether it's going to break out to the downside or it's going to break out to the upside. It depends on the currency, the market momentum, and every other thing, and the time frame and all of that. So nobody knows, right? We just wait and see. Okay, so what I'm saying is very simple. For the market cycle, the market will move from a range, then it will go into a breakout mode. Breakout is also referred to as a strong trend. All right, that moment when the market breaks out of a trading range, that's a strong trend. After that breakout, what you would see is usually a trend, right? Okay, what you see is a trend, and there can be a breakout to the upside, and then the trend which follows might be in the opposite side, meaning it doesn't happen all the time, but you can have a range like this, right? You can have a range like this, and then the market will break out. This is a strong trend, right? This is a strong trend. Now, this is the range. This is the breakout. The trend can either go like this, meaning it can continue, right? The trend can continue, or the trend can go the opposite way. But we expect a trend. And there are so many reasons for this. See, what you observe is that market will go from compression to expansion. Market will always go from compression to expansion. It cannot expand forever. It cannot compress forever. From the trading range area, what you have is compression, right? What you have is compression. It accumulates volume. When it has accumulated enough volume, you now move to the expansion phase. This is a reversible reaction. It goes from compression to expansion. That's what it continues to do. If the market has consolidated for a long time, it's inevitable for the market to break out. It must break out eventually. It must break out. And then when it has used all of its power and strength to push market from here to here, you don't expect it to continue back forever. No. It will now go back to what? Compression. That's where you now have maybe a healthy trend, a weak trend, a pullback, something like that, right? So you can have, after the breakout, you can have a continuation or you can have a reversal. One of those two will happen. Then, that brings me, I'm sure you understand where I'm coming from with this now. So, and then this, what do you have here? When the trend is going, right? When the trend is going, it will not continue forever. Eventually, if I put a trend line, you see that what will happen is it will break that trend line. You see, it will break the trend line. And from that area where the trend line is broken, what do you have? A trading range. What happens again? Consolidation within that trading range. Consolidation. Orders are packed in. And then what happens when the orders are swept, the market will have enough momentum again to push for another breakout. And then it continues like that. Continues like that. Okay, so that's the market cycle. That's the market cycle. Goes from trading range to breakout. Breakout can also be called a strong trend, right? A strong trend. That's where you see the market moves endlessly. You know, strong trend. And then from there, it will go into a healthy trend. You know, what we refer to as a channel, right? You can see that a trend, usually you can put a channel there, right? And then it goes back to a trading range, right? So take note of that. Wyckoff theory, right? This is the guy that now explained this market cycle to us, right? He was the one that now said, okay, see what is actually happening. Market is accumulating orders, right? When the market accumulates the orders, right? So he says the market will move in 4 phases, that there are 4 phases, right? It goes from accumulation. After the accumulation, there is a spring. I'm going to talk about this in a minute. There's a spring. This is what we call today. We refer, this is, I don't know how many decades ago or centuries ago, but this is a long time ago, right? And they refer to this spring is what we refer to today as inducement. Okay, I will show you when I get into the chart, or as I explain further. So after the accumulation, there's always a markup. All right, and when the markup happens, this is the markup is assumed to be an uptrend. It's an uptrend, right? And then after that markup, what you see is distribution, right? You see distribution, all right? Distribution is another area of consolidation, right? What you have here is an upthrust. All right, what you have there is an upthrust, and then after that you have what we call the markdown. Okay, guys. So this one is the downtrend, and if I just put that thing in a pictorial perspective for you to see what we're saying, is he just says that the market will consolidate. The market will consolidate. You see it is ranging, right? That's what he's saying. It's going to range. Now, what you now notice is that the market is going to make a sharp move to the downside, where it will trigger all the orders that are stacked up here. Then when it does this, it will now go up. This is the one he calls the spring, right? As the one he calls the spring. Is it the spring or the upthrust? I have to confirm that. Been a long time since I did this particular study, right? And you can see that's the essence. So that's the reason why you really have to understand what you're doing, because I have just come from somewhere right now, and I just opened the chat. I say, okay, fine, let me teach these guys, So, and you can see I'm able to still share all of these things despite the fact that it's been quite a long time, So that's why I say master everything in-depthly. Understand why it is the way it is, right? Understand why it is the way it is. No cramming. Just understand it, all right? So as I always say, what the word is, what the name is not important. The important thing is that you are making money with the idea. You understand what we are saying, and you're making money with the concept. All right, I'll just ensure that that's the correct thing while I go on, so that if I give you the CA, you don't, make any mistakes. So what you have here, you can see, is that we have had, I'll just label this number one and number 3 are going to be a consolidation phase, while number 2 and number 4 are going to be a trending phase. So what happened here? First one, accumulation. Then we had the market, deep into this area. to take all the orders. And now after that, what happens? The market is going up. And then the market gets up to a certain point. It will not continue forever, right? So what do you notice? A consolidation will begin. Consolidation will begin, right? Consolidation begins. And then what happens? The market wants to the market can either choose to sweep, it can repeat what it has done. It can sweep the liquidity again here and continue up. And I'm going to teach you this when I teach you supply and demand. This is very important. These areas of accumulation, these areas of consolidation, they are the things we call supply and demand. When you look at your chart, that thing you call supply and demand is this area of consolidation. There are different types. You have the rally base rally. You have the rally base drop. Okay, I'm going to teach you all of those things, but I'm just mentioning it now so that when I start to talk about it, it will make some sense to you. See, from this area now, you have the consolidation, you have the sweep. Now, I'm going to go back some steps, right? So from this area, what do you see? See, the market can decide to, instead of going up, it can sweep the liquidity here and come back down, right? Can sweep the liquidity on the opposite side and reverse. This is number one, accumulation. This is the spring. This is the uptrend, which is markup. This is the markup, number two. This is the markup. This area here is the distribution, number three. That's the distribution, right? That area is the distribution. Okay, and then this is the markdown, number four, right? That's the markdown. Okay, so please take note of what I've just said, just to go over it again. All right. So just to go over it again, this is the first area where everything started from, right? This is, remember, this is Wyckoff's theory, right? This is Wyckoff telling you that market actually moves in phases. And there's been, I tell you what, there's been a lot of theories, right? There's been a lot of theories over the years. There's been a lot of theories. I have to tell you. Some of you, if I begin to mention these things now, some of you know about the Elliott wave theory. It's a theory. All right. So why I'm teaching you that of Wyckoff's is because I tell you, Wyckoff is the closest way that I can explain supply and demand. All right. Because what drives prices is supply demand, right? When there is supply, when supply fails, right, demand takes over, right? When demand fails, supply takes over, right? So the market is moving from supply to demand. I hope you understand what I'm saying, guys. The market is always moving from supply to demand. Always moving from supply to demand, from demand to supply. And this is going to make up that thing I was talking about, what I was talking about when I said I'm going to teach you order flow, right? So, but I need you to understand these things, and I need you to not just get them, when somebody say, oh, this is supply, this is demand, this is this, you need to know where it's coming from. Why do we say it is supply? Why do we say it's demand? Right? You need to understand it very, very well. Okay? So I'll go again. So see what we're saying. Let me make it very clear. You will usually have the market ranging, right? This is the market ranging. Now what you notice is that the market will come down lower, and then it will push in. right? Then what you have next? Breakout. What do you have next? Uptrend, right? Uptrend. And then what you have? Climax. This is the Bitcoin at 60,000, right? Bitcoin at 60,000. When that is called a climax, guys. It's called a climax. Those of you who know me, earlier, you understand that I teach climax, and it's something that we look out for when we want to, we want to see what we call an FFF, a faded final flag, right? A faded final flag. This is not what I'm teaching you here, but it's a concept, right? It's saying that it's a late bullish flag, late in a move. If I see any small consolidation here and a strong push, it's an FFF, right? It's a reversal. It's a reversal. It's a bullish flag late in a bullish trend. And what it tells you is that that market is done. It's climax. You know what climax means, guys. You know what climax means. Climax is I've reached my plateau, right? I can't go any further. That's what climax means, right? So Wyckoff talked about this. He talked about the climax, and then after that, what you get is another consolidation phase, right? And then what happens after that? You get an upthrust, right? And I believe that's correct because and that's what it is. This guy here is the spring. This guy is the spring. It's the same thing we talk about when we look at liquidity sweep, right? If you look at this area here, what do you see? There's a sweep. There's a sweep here. This is the upthrust. That's the upthrust, right? That's the upthrust. Okay. So what you see here is consolidation. There's a consolidation. Market is resting. Market is compressing. And then here, what do you see? Here, markup. Market is expanding. Market is expanding. What do you see here? What do you see here? Compression. Again. So you can see it's just going from, consolidation, expansion, consolidation. This is markdown, right? This is markdown. Markdown. Expansion. The order in which it is presented to us is not known. The order, are we going to have consolidation before we get markdown? We don't know. Are we going to have consolidation before we get markup? We don't know. But this is the cycle, guys. That's the cycle. That's the way the market moves. And I hope you understand this. Now, the reason why I've taken you into Wyckoff is because I need to teach you, about supply and demand, right? So the idea here is, see, I'm not going to start to teach you anything about supply and demand as to, economics. This is what I used to do, some years ago, where I'll tell you, okay, if a shoe is, if a shoe is let's say $1,000. A shoe is $1,000, right? And let's say we see that Ronaldo now wore that shoe that is $1,000. What's going to happen to the price of that shoe? It will go high, right? Why? Because there will be more demand for it. Okay, so let's say that this is your $1,000. If this area is your $1,000, right? Now, if we see that Ronaldo wore the shoe, the price is $1,000. Let's say if you can bargain maybe $950, that's why you have range, right? $950, $1,100, $950, something like that, right? And then $1,002, then later $1,900, $950, and all of a sudden maybe it gets to somewhere around $800. If it gets to $800, what's going to happen to it? It's a low price. A lot of people will come and buy. Is it not? A lot of people will come and buy. And then what happens? Let's say something now happens. There's now a need for more people to buy. Like the example I gave, let's say Davido. You see Davido wearing that shoe. what's going to happen? Everybody will want to buy the shoe. Everybody will request for the shoe. And that's what we call demand. So demand has come into the market. Demand has come into the market. It has flooded the market for that shoe. So what happens? Markup. The price will rise. They don't have enough shoes. And there's a lot of people that want that shoe. A lot of people want that shoe. They can't sell it at 1,000. They will try to sell at 1,500, 2,000, 3,000, 4,000. Because the shoe was worn by Ronaldo. Right? They try to sell it higher. You know, everybody wants to take a picture and say, oh, this is the same shoe Ronaldo wore. That's what I'm wearing. You know, they want to buy it. Right? So you're going to drive the price higher. So this is the demand zone. That's what we call it. This is the demand zone. And I can reduce this to a single candle. I can reduce it to a single candle, one bar. Right? To a bar, to a candle. This zone can be a candle. Remember that if this is 5 minutes, I can have all of this happen, you know, as a range. But if you go to daily, all of those 5 minutes bars will just be one single bar. Is it not? Then the next day, what will happen? You have another candle, you know, breakout. Right? That's what's going to happen the next day. So what do you say? You say that this candle here is the demand. That is the demand. And it's the same thing when you get to the high here. When you get to the high here, $5,000 for one pair of shoe. For what? For what? Right? Why should we buy a shoe for $5,000? This is the supply area. Right? This is the supply area. Why? Why is it the supply area? Because at $5,000, nobody gonna like to buy the shoe anymore. Right? A lot of people have gone to, you know, purchase the shoe. So there's a lot of people selling the shoe now. The number of people who are willing to buy at $5,000 are lesser. So people don't want to buy anymore. Everybody's waiting for the price to come down before they buy. Nobody wants to buy it at 5,000. They will say, I beg, if it's that one, I'm not wearing the shoe. You know, how can I buy a pair of shoe for $5,000? It doesn't mean that there are no people who are not going to say, okay, I'll take it 5,500. I'll buy, you know, I'll buy, no problem. And then some people will just keep buying, right? So what was going to happen when they keep this shoe at the store and see that, you know, the supply is there, right? The shoe is at the store. But there are no buyers. There are no buyers. What's going to happen? The people that have the shoes will be forced to crash the price of the shoe so that buyers can come back. So this area is called the supply. Right? It's called the supply. This is the markup. In terms of supply and demand, a markup is called a rally, right? Rally means to go up. A markdown is called drop. It's a drop. Okay? And then the area, whether it's supply, whether it's demand, we call it a base. All right, so whether it's a demand area or the supply area is called a base. And I'm going to somewhere with this. All right, I'm going to somewhere with this. So what we're saying is, if the market pushes up, right, if we have the market, you know, in a consolidation phase like this area is the base. After this area, we expect some form of manipulation, and then the market goes up. So here is the base. So this is an example of rally. This is an example of rally base rally. Take note of that. I'm going to ask you when I give you the CA, right? This is an example of rally base rally. What do you have here? You have what? This is your demand. I beg your pardon. This is your demand, right? Because it is this is after this you continue upwards, right? That's your. But if you have something like this coming down, right? You have, you know, consolidation, consolidation like this, and then some form of manipulation, and then the market comes down. What do you have? Drop. This is drop, base, drop. Okay, drop, base, drop. What you have here is what? The supply. You can see that supply is for the down move, the downtrend, while the demand is for what? The uptrend. Okay, and then if the market is going down, we say it's a drop. All right, if the market is going up, we say it's a rally. And then there are different ways I can look at supply and demand, right? The market can go up very quickly, and then we just have, we have our range like this, we have, consolidation like this, and then instead of continuing up or down, the market can just reverse. So in this case, we have what? Rally, base, drop. So what do you have here? Is this demand or supply? This is supply, right? This is supply, because you have what? It's coming from rally to the base to the drop. So this is supply. The opposite is when the market is like this, right? Market is like this. What you see, consolidation, right? Consolidation area, and then some form of manipulation, and then the market goes up. What do you say? This is drop, base, rally, right? So what do you have here? This is demand. So if you see the things I've showed you here, all the things I've showed you so far, what you have is you can have an uptrend. You can have an uptrend like this. You can have an uptrend. See, I'm showing you something now. You can have an uptrend, right? It's going to lead us to some other things. Then all of a sudden, you're going to have what we call an indecision bar. Indecision bar, most likely in the opposite direction, meaning a different color. A different color. Then what you now have next, you will see that there's a sweep. There's a sweep. Take note of that. There's a sweep. Right? I like it to have a sweep. If it doesn't have a sweep, I don't like it. But it doesn't always have a sweep. But what will characterize this move for us, guys? I want you to take note of what I just asked you. What's going to characterize this move is going to be the fair value gap. Going to be the fair value gap. It's going to be the fair value gap. See, this is what you're going to see. This is an example of, this is when we're just talking about, bars. This is, looking at a bigger picture. This is when you go to a higher time frame. This is the higher time frame. Let's say this is M15. If this is M15, you're going to see that area of demand is a range. But if you go to H4, it can just be, all this candle here can just be one. It can just be one H4 candle, right? Which is this one I'm trying to show you here. Can just be one H4 candle. So what do you say? What do you say? What you say is very simple. Now see, I did look at this week here. I did it on purpose. I did it on purpose. The reason I put it there is because I like to see it sweep this one. I like to see it sweep that one. Because we know that what Wyckoff explained to us is that there will be a spring before a rally, right? There's going to be a spring, a manipulation before a rally. And on the downtrend area, there's going to be some form of manipulation before going down. So I prefer, or I would say, the higher probability supply zones will have some form of sweep. Now, when they have sweep, they will equally have a gap. Take note of that. So if there is no gap, it means that this is not a strong uptrend. It's not strong, right? We want to see surge. We want to see surge, pump, whatever you like. But if we consolidate, you cannot consolidate. After you consolidate, and then we say, oh, this is our demand zone. This is our demand zone. Then you are now coming up. You are going kurukere. You're not, no strength. You're just doing like, this is not demand zone. You will see it. It will go with full force, and it will have gaps. That is what a a valid demand zone or supply zone will give you. So the characteristics of a demand or a valid demand or supply is that it's going to have most times is a consolidation bar, right? It's a consolidation bar, meaning indecision bar, right? It's gonna be something like this most times that shows that there's indecisiveness, right? Another thing is you might see a sweep. It will be swept, right? It will be swept. That's this area here. It will be swept. And then lastly, it must have gapping bars, right? So there must be gap on subsequent bars. Gap on subsequent bars. And there's one thing I like to add. It must lead to a break of structure. Must lead to break of structure. If it's strong enough, it's supposed to go and do something. It must lead to a break of structure. See, if we want a demand to go up, right? If we want to say that let's say that there's a demand here, and we want this demand to be valid, we need to see gaps, and we need to see this demand actually break this structure. That is what makes this demand valid. That's what makes it valid. You see it now. So first, you understand why this is the demand. Now, you understand because I already teach you what the gap is. And I already taught you what the break of structure is. So that is what's going to make this guy valid. Is that okay? So what we are interested in is which bar. So in this example I gave you here, where is the demand? This is the demand. So in this case, where is your POI? Here, you mark it out from this bar like this. This is your POI. This is your demand zone. And this is an example. This is your demand zone. This is an example of what? Of rally base rally. And it can be anyhow. It can be anyhow. Let me show you another example here. We can have the bars coming down, right? I think I'll use more room. Or let me just squeeze it in here. See, you can have the bars coming down like this, right? You can have the bars coming down, right? You can have, something like this, right? Opposing bar, right? And then, you have something like this, right? Coming down, right? You can have something like that coming down. What do you have here? Supply. This is supply. Why? This is the demand, indecision bar, opposing bar, right? This is the opposing bar. This is the last buying in this downtrend, right? Is the last buying action before a sell, right? Is the last time they try to buy. Here. That's the last place is in that bar. That's the last place where the traders tried to buy before eventually it failed and dropped. So there's been a consolidation here. So this is your supply zone. This is your supply zone. In the downtrend, this is the supply zone. So what are we looking for? We are waiting for market to pull back to this area, which is our POI. Then we can sell. That's how to trade supply zone. That's how to trade supply zone. You want to use it as a point of reference for you to sell or buy in the future. If we are going like this, we now say, oh yeah, we have supply zone here. Supply zone is a zone that should be defended. I beg your pardon, guys. This is the demand zone, right? In an uptrend, this is the demand zone, right? So see, the idea here is that and why is this a demand zone? I told you why it's a demand zone, right? See, here, what you have, of course, your demand is the last selling here before the market breaks to the upside. That's the demand zone. See, it has a gap. Take note of that. Imbalance. It has broken structure. That's what makes this a valid demand zone. Now, if there is a break of structure, it means that there is a failed supply. Right? It means that supply has failed to hold. Supply has what? Failed to hold. And this is going to explain further why I teach you something. See what I teach you. I tell you that if you want to mark a valid swing, wait for what to happen. Wait for this to happen. Why? Because, see here, this is a break of structure. This is also a failed supply. Meaning that supply is failing to hold. And let me tell you what I mean by supply failing to hold. Anytime, if this area here, if let's say that shoe I talked about is $1,000, and then it got to how much? $5,000, right? It got to $5,000. If this market ever comes back to $1,000, what do you think people are going to do? They will buy. That's what we mean when we say that demand is holding, right? Demand is holding, meaning that people are still interested in buying that shoe because the price has become lower, right? The price is lower, so they want to buy. Anytime it comes back to 1,000, they will buy. Anytime it comes back to 1,000, if it now rises, let's say to $7,000, anytime the market comes back to, let's say, $2,000, they will buy again. Because they saw it at 7,000 and they are not sure it's going to come back to 1,000 anymore. Right? And what is happening here? Anytime it gets to 5,000, it fails to hold at 5,000. So it means that supply is failing. What happens if 1,000 eventually doesn't hold? Right? Let's say that as it's going up, it gets back to that $1,000, right? But it breaks. It means that they are not interested in that shoe anymore. They are not interested in the shoe anymore. It comes down to $400. It means that it has gone out of vogue. Nobody's interested. But then, it doesn't go to zero, right? So it has broken, right? So see what I'm saying, right? At this point, what are you now going to start anticipating? What are you going to start anticipating? You're going to start saying, 1,000 was the demand. There was demand for this shoe at 1,000. But we got to 1,000. Now we are at 400. I think this shoe has lost its value. So what are traders going to be looking to do? They are going to sell. And why are they trying to sell? Take it to $200. Take it to $150. Why? Because the demand has failed. Demand has failed. Buyers were supposed to come at 1,000 to push it up, but they did not show up. It broke down to 700. The buyers did not come. Or let's say it got to 700, they pushed it back, let's say 900. They couldn't take it beyond 900, they push it to 400. It's gone. It's a reversal, right? Why is it a reversal? Because demand has failed to hold. And that's what we're teaching. That's what we're teaching. So why I always say, let us see a break of structure first, which is going to be the fake move, which is the correct inducement, is because the break of structure is the faker. It's the first one that induces people to say, oh, we want to buy, right? And then what is happening again? Supply is failing in this case. Supply is failing. So since supply is failing to hold, there is a chance that the market will print higher prices. So what we are saying here is we want to see what gives us confidence to buy a pullback. What gives us that confidence is we have seen that, the market has swept the liquidity. The supply cannot hold anymore. Now, since we have swept liquidity, we have broken structure, and there is a failed supply, right? There's a failed supply. That is the confirmation that anytime this market pulls back, supply is no longer holding. So there's a chance that the next supply here will not hold. That's why we put our target there. I hope you get what I'm saying here. So we are saying that supply in the future will not hold. So if supply fails, this is induced and the market is able to go, we see that supply has failed. Since supply has failed, I have more confirmation to buy the demand here. That's what we are saying. And this is exactly what you need to understand when it comes to supply and demand. I can bet you there's no better way to teach supply and demand. Right? Supply and demand is it brings us to order flow. Everything I've been teaching you is order flow, right? Order flow. What is the order flow? The order flow is to the upside in this case. Why? Because the demand is continuously holding. This is your order flow. Right? This is order flow is the selling the entire selling action. The entire selling action before a buy in an uptrend, right? If it's a downtrend, it will be the entire buying action before a sell. Simple English. This is the entire selling action. That's the entire selling action before what the market bought, right? Before you have a buy. If you have a downtrend, what you see is is the order flow is all this area here, right? All the last, you see all those selling, all the buying, right? The entire buying that's taking place, all the buying that is taking place before you have a sell is the order flow. So what we're saying is, see, what I need you to understand there is very simple. Order flow is teaching us that demand is holding. When you open a market, first thing you want to see is what is the order flow. In this case, the order flow is what? Is a buy, is an uptrend. And why do we say is an uptrend? Because demand is holding and supply is failing. Supply is failing in an uptrend. See, the supply that was here failed, right? It was broken. The supply that was here failed. It was broken. Supply that was here failed. It was broken. Supply that was on this one failed. It was broken. But what happened to the demand? Demand held. What happened to demand? Demand held. What happened to demand? Demand held. So demand is holding, but supply is being broken. This is the supply is being broken. This is the supply is being broken. Immediately the market exceeds the high, supply is broken. But you can see how demand is respected. Order flow is saying that, you see this range where I sold from, right? That range where I sold from, when the market makes a new break of structure, this area is my order flow. This is the zone where I want to buy from again. Once the market enters here, this is order flow now. It's an opportunity to go up again. Now what happens again? This is the new order flow. This area from here to here is the new order flow. That's where I'm looking to join the market to buy from. So if you want to refine the order flow, we can now say, oh, because order flow is too wide, right? We can say that order flow is too wide, right? It's too wide for us to make decisions. So we now refine order flow to what we call order block, right? So instead of taking all of this area as the area where we want to buy from, right? Instead of taking all this area as the area where we want to buy from, we want to see precision. Where is that candle where the bounce is going to happen? That's when we now refine order flow to order block. Order flow is the entire selling, right? Is the entire selling. Order block is the last candle or bar. It's not necessarily a selling. It's the last candle or the last bar, whatever you like to call it, right? The last bar before either you call the gap or the surge, right? It's the last bar before the surge. Meaning You want the candle that has the gap, right? Or the other block is, if I come into this leg, all of this is made up of candles. There is a particular candle, whether it's the selling one or is the buying one. There is a particular candle here that swept the previous low and that has a gap. That candle is the order block. That's the order block. All of this area is the order flow. But the candle itself that owns the gap, the candle that owns the gap is the order block. The entire selling is the order flow. If I have a complicated order flow, maybe something like this, not straightforward, something like this, right? Before I have a high, this area is the order flow. So this is the last selling area before the buy, instead of all of this area. I'll do it again. If the market goes up and is coming down, and I have, something like this, and then finally I have a last push before the market goes up. See, there's a push here, and here. This last one here is the order flow. That is the last area where we had selling before the market pushed up. So this is the area where I want to buy from. But we are now saying this order flow is too much. Our stop loss will be wide. That's why I say order flow is wide. Our stop loss will be wide. How can we refine this order flow to just one bar? To only one candle, right? In fact, I'm going to even still teach you how to refine that one candle to a specific point. I'm going to teach you how to refine it to a specific point on that candle. Right? So see where it's coming from order flow. Remember what we started with? We said demand is holding. And this order flow area shows that demand is constantly holding and supply is failing. In a downtrend, it shows that supply is constantly holding and demand is failing. Demand is failing. Supply is holding. Supply is holding. Demand is failing, right? Like that. So, order block is the last bar that you see before the gap happens. Order block is the last bar that you see before the gap happens. Order block is the candle that owns the bar that has the gap. Order block, if this is the last bar in the supply area, if this is the last bar in the supply area, and now I don't care whether it's selling or buying, but it's the last bar that swept, meaning it has the highest, followed by another candle. Now, what I want you to take notice of is that the candle that follows it has a gap. See it? There's a gap here. See it from this high here to this area. You can see that there's a gap. Bar 1, bar 2, and bar 3. Bar 1 is the order block. Bar 2 is the bar that has the gap. And bar 3 is the bar that confirms that gap. Look at the wick. See the wick. It did not run into this place to close it. It left a gap. It left an imbalance. That is what makes this order block a valid order block. I hope you understand that. And remember what I said. You can now refine and say, okay, this is the area, this order block candle is the area where I expect the market to come and mitigate and continue. That's the area where I expect the market to come back, mitigate it, and continue. So what? I can put my limit entry here, put my stop loss above that candle, and then put my target at the break of structure. Because I saw that demand has been holding, supply has been failing, or in this case, since I'm selling, demand has been failing, supply has been holding. Now I expect the market to come back to the order block, test that order block, and then continue downwards to break the next supply. That's what I expect. So this is called what? The POI in this case. That candle is called the POI. That candle, the one that has that gap. This is the candle that has the gap. See it. This candle has the gap. See the gap. The gap is here. You can see it. The gap was here. We had another bar here. See, this gap belongs to this candle. Why I'm telling you this is because you can have a cluster of candles here. It's the candle that has the gap that is your POI. So this is the one that you're using as your POI. The owner of the gap, the last bar before the gap. And the reason why we expect market to come back to this bar, mitigate it, and continue downwards is because we remember what I told you in the first or second class, where I taught you that what these guys do is very simple. They will stack up the position. You know, we're trying to as much as we can, you know, follow the demand, right? And the institutions, you know, the guys that have more money than we do, right? So we're saying that if they actually intend, if they intend to push the price higher, they will sell first. When they sell, if they sell, it means that they sold to this point. There is a candle here. There is a candle here where they sold to. There's a candle there. Now, traders at this point, traders are going to think that the market is selling. What would they now do? They'll put their stop losses here. So they have deceived you. Let's say they want to sell a total of $1 billion. Right? They want to sell $1 billion. Now, what would they do? They would maybe use $400 million to push the market lower. When they have pushed the market lower in this analogy that I'm giving you, right? Their $4 million is open here, is open down to this bar. Then they have how much? They have about $6 million. They now use $6 million to push this market up so that they can take your stop losses here. If they take everybody's stop losses here, they would have maybe added, like, let's say, to that $1 billion, they might have added, let's say, $1 million to it. Or $2 million. Now what happens? They still have open position here, about 400 million. But they have made some gain on that $600 million that they used to push this market higher. So what are they going to do? They cannot leave their initial position in a loss. They will now pull back. Where? To that last candle. To that last candle. How do you know that this is their 600 million? It's going to have a gap. It's not going to be going small. 600 million comes into the market. You see that there's a gap. So the last candle before the gap happens is the other block in this case. We call it the institutionally funded candle. It's the candle that has the gap. Some people say sponsored candle. That is your other block. It's the last candle before you now have that surge, that gap, right? And then what are they trying to do? They are trying to close their 400 million that is running here. So when they come back to that candle, see, when they come back to this candle here, where that other block is, they mitigate and close that initial $400 million. When they close it, right? When they close that money, then the market continues up. Now they are not in any loss. That's what we are taught. I don't know if it's true or not, but that's what we are taught. And it makes sense to me, right? It makes sense to me because they can do this on and on and on and on and on. And they keep making profit from the $1 million, $2 million, $3 million. These are the market makers, right? And that's why the best thing that you can do for yourself is to follow that footprint. When you see that they have come here, deposit an order block, and that order block is characterized by a gap and a break of structure and gap, what do you know? What do you know? We have institutional candle. We have institutional candle. What do you expect? From this point, we know that they must come to mitigate their order here in this order flow. They must mitigate that order. So when they come to mitigate that order, you have your limit order here to buy. You have your buy limit. Where is your target? Here. Stop loss below. This is your stop loss. This is your buy limit. This is your target. So you do that on and on and on and on and on and on. All right. So I think I'm going to stop here now, so that it doesn't get too long, okay, and tiring. I have given you excess information on this particular one. I have given you a lot of information. I started with market cycle, and then I touched Wyckoff, and then from Wyckoff we started to look at supply and demand. And all of these things are things that you can teach somebody in one class, but I taught you I taught everything in one class. So take your time, go over this thing over and over, right? And then from supply and demand, I looked at order flow, and then we talked about premium and discount. We talked about volume imbalance. We talked about order blocks. All right. In the previous class, we have talked about the imbalance already, right? So today I touched volume imbalance, and then we looked at the PD, the premium and discount. We touched order flow, and then we said that order flow can be refined to give us an order block, and then we looked at supply and demand. All right. And when I go into the chart, I'm going to show you. And then remember that I talk about failed supply and demand. These are all important concepts that you use when you're placing the trade, when you're marking your POI. All right. So in the next class, I'm going to go into the chart. Okay. So maybe in the next class, I'll just touch on breaker block and maybe support and resistance a little bit, because they are very, very closely related. Right. So we look at breaker block, supply and demand. It's not going to take time. It's just a very simple concept, right? Breaker block, supply and demand. I'll teach that. And then I'm going to now open the chart and show you everything here one by one. So I'll show you, what I mean by PD, premium and discount, show you what I mean by volume and volume imbalance, show you what I mean by order flow, show you what I mean by order block, show you, we're going to try to scan for supply and demand zones. So you see what a rally-based rally is, a rally-based drop is, a base drop rally is, what, right? So I'll stop here, guys. Your assignment for now is, as much as you can, open the charts to see if by yourself you can mark all these things that I have labeled. So when I now give you the correction, you can see how well you have done. All right, so that should be your assignment. Open the charts. Okay, I know that some of these informations are there, online, but you can see that when I teach, I like to dig it deep. I like to go very deep so that you understand what you're doing, why you are doing it. Right? That's where confidence comes from. So when you place a trade, you know that yes, I'm confident that this is going to happen. If I take an SL, I take an SL because it is probabilistic. I'm not supposed to expect anything from any trade. My job is to just place the trade, right? The outcome is probabilistic. Okay, I don't know what's going to happen. So, but at best, I can try to observe the footprint and hope that I'm right. You cannot be right all the time, but at best, I hope that I'm right, a good percentage of the time. All right, and then when I'm right, my reward has to be good. So again, we have to also say, okay, hope you're holding your trades to your target, right? So trade management, that's a different topic. I'm going to go into that topic. So, but for now, I'm going to close the class here, and I'll see you in the next class. Until next time, do have a wonderful time. Continue to study hard, and then may the peeps go with you. Cheers, guys.